Hey, welcome to this week's video. Not using your profit and loss statement, or also known as statement of operations or the P&L, to manage your business is like driving your car blindfolded, but learning how to read one is not that intuitive. So in this video, I'll show you how to break down and read a P&L statement, how each line item interacts, and what they mean for your company's financial performance. In addition, I'll show you what an accurate profit and loss statement is and how it can help you better troubleshoot, modify, and plan. By the end of this video, you'll be able to read a P&L statement just like Warren Buffett does. So let's get to work. Okay, so a P&L statement shows you how much your business has spent and earned over a specific period of time. Basically, your revenue less expenses over a set period of time. The period of time is the first thing you need to check when looking at your P&L statement, so you know what period you're looking at. Owners differ on the time period they'd like to see, so think about it how best you'd like to review your P&L statement, and then set this period. You can actually experiment with what works best for you. I recommend you look at a month, year to date, and then compare this to the previous period. We'll discuss this a bit more later on in the video. The key though is that your P&L should be a useful tool for your business. If it's used in the correct way, I guarantee it will be one of the most important tools you'll use in your business. Okay, so let's talk about cash versus accrual basis. I did a separate video on this, which I will link to in the show notes. But basically, you have a couple of options when viewing and recording transactions in your P&L statements, and you need to know what method your P&L was reported in. So under the cash basis, transactions in your profit and loss statements are recorded when the cash is received and when the cash exits the business. Under the accrual method, though, transactions are recorded when the economics of the transactions have occurred, such as when the products or services are completed or when the goods are received, regardless of when the cash is received or spent. If the timing of transactions in your business pretty much coincides with the transfer or receipt of funds, then the cash basis would probably make sense. If not, the accrual basis could make sense, or maybe even a hybrid method of the two might work for you. The key is to work with your accountant to figure out what makes the most sense. Why? Because if you're looking at your P&L and the timing varies, you're going to receive a P&L that could be confusing and meaningless. Again, check out the video that I will link to, and this will make a little more sense. Okay, so let's talk about sales. The first section of your profit and loss statement relates to sales. Pretty straightforward, but I see a lot of profit and loss statements that have just one line item that says sales. And this could be a mistake if your business has multiple streams of revenues. Thus, you should consider this when reviewing your profit and loss statement. Let me show you an example. Here are the financial results for Apple for the 3 months ended March 26, 2022. And I know March 26 doesn't make a lot of sense, but some companies are on a different time period of 3 months so as to show the exact number of days when comparing to another period, which I'll show you a little bit later. But the key here is that you're not getting just sales as one line item. Apple is clearly telling you that products and services represents the major categories of their business. If you were an auto repair shop, for example, you might show labor sales, part sales, etc. The key is that you should look at the major categories of your business so as to see what's going on in your business and to make your P&L more meaningful. As you can see here, Apple actually breaks down their sales by geographical location as well, and they actually break it down by product, so there's quite a bit of detail on sales. Okay, so cost of goods sold, or also known as cost of sales, represents what it costs to deliver the goods or services that you contracted with your customer. Such costs include things like materials, labor, shipping. These are things that are spent to fulfill your obligations to your customers. But these costs don't include expenses such as rent, sales, or utilities that specifically relate to the overhead of the business, which we'll explain a little bit later. Here is an example that Apple has. Notice that the cost of sales is also separated into the same categories as sales. This is important when you're looking at your gross margin, which I'll discuss next. But overall, you can see here that Apple is showing you what the costs are that related specifically to the products and specifically to the services. So now let's talk about gross margin, or sometimes known as gross profit. This is simply the sales less the cost of goods sold. This tells you how profitable your business is from the delivery of the product or services that you sell. Gross margin is a critical measure in your business that you should constantly review and adjust if your gross margin is not within expectations. This is why it is critical to get your sales categories and cost of sales correct. If you don't, your gross margin won't be accurate, and that can render your P&L somewhat useless. So here is a breakdown of the gross margin for Apple. The gross margin is about $43 million, and this tells you that of the sales delivered, Apple kept about 43 cents of every dollar sold. This 43 cents is what's left over to cover the overhead of the business. More specifically, we can actually see what the gross margin is for the products and what it is for the services. Based on Apple's numbers, you can calculate the profit margin for these categories. Can you see maybe why this would be useful? In Apple's case, Apple certainly would like to increase its services business because revenues actually enjoy a much higher margin than the products does, which the investors as well would like to see. Okay, so let's discuss overhead. These are expenses, also known as operating costs. These represent costs such as rent, office supplies, sales, expenses related to advertising, marketing, insurance. Basically, it's everything that is not related to cost to get the product delivered to your customer. Here you can see the operating expenses for Apple. I like to break this out way more than this so that you can actually see the major costs like auto, administrative costs, travel and entertainment, sales and marketing, and administrative salaries. The costs in the Apple's case here are lumped together in the selling, general, and administration line by Apple. This further shows how important sales and cost of sales are to Apple, as they spent more time breaking them out in more detail than their overhead costs. I like to look at the operating margin, which to me is a good gauge how a business as a whole is performing. And actually note, you can probably should calculate the operating margin by taking the income of the 30 million in this case and dividing this by the total sales, which in this case would give you about 31 cents of every dollar Apple sold it keeps after paying its cost of sales and operating costs. That's actually a really good number. Some of the remaining items in the P&L, which are often called other income and expenses, they include items that are generally not related to cost of sales and overhead, which means things like taxes, for example. And then what is left over is your net income or loss. In this case, you can see that Apple's net income after other income and expenses is $25 million, and that is their net income. So what else should you do with your profit and loss statement? Well, the big thing is review trends, which I mentioned a little bit earlier. You should compare your current P&L with the same period or a different time frame as the prior year. Reviewing to previous periods is one of the best uses of your profit and loss statements next to actually looking at your profit margins. Here's an example for Apple. You can see in Apple the sales are up and the margins are up, and then you can drill down and say, well, why might that be? And as you look at the numbers, you can see that services are up, which has a higher margin, and that is contributing to an overall higher margin for the company. Also, you can break down these sales and you can take a look at what is driving the increase in sales and to see what impact that has on your profit and loss statement. The key is to develop this report that best serves you and helps you understand the business and acts like a trigger for you to go and look at other numbers that might not meet what the expectations you have for those particular numbers. So some key takeaways are, understand if you should be on the accrual or cash basis of accounting. Break out your sales and cost of sales into major categories that make sense, and review your gross profit margins by these major sales categories. Break out your operating cost and review your operating margin, and review your trends. Most of all, make sure that your P&L can be used in a useful way to run your business and allow you to dive in deeper to things that don't meet your expectations. So that's it for this week's video. If you got any value out of it, it'd be awesome if you hit that thumbs up. And if you haven't subscribed, it'd be great to have you as a subscriber. And then down below, I have some ebooks that might be helpful to you to dive in more in the profitability of your business. Until next time, thanks for watching.